Now, we've looked at wages and the capture of wage data. Now let's discuss other types of income, including interest, dividends, alimony, and unemployment. Note that interest, dividends, and alimony are in Lesson 8 in Publication 4491. Unemployment is covered in Lesson 12. All right, is interest earned or not earned? Despite the fact that money you might have deposited in a bank earns interest, a taxpayer really doesn't need to do anything while it was in the bank to receive the extra money. So interest is not earned. Interest can be paid for cash held within checking and bank accounts, banks and credit unions, or for bonds of various types, and for money loaned out to others. If I loan money out to my coworker Bill, and he pays me back with interest, that interest should be reported to me, or by me, I should say, as income. We generally see two types of interest forms. Most 1099 INT forms, like the one shown here, are issued by financial institutions such as banks or credit unions. Most financial institutions don't send the taxpayer a Form 1099 INT if they receive less than $10 in interest. Now, the taxpayer may provide an end-of-year statement with an amount. In this case, we enter it as if there were a 1099 INT. You enter the amounts as they appear on the Form 1099 INT in the corresponding boxes on the tax layer entry screen, even those that are titled tax exempt. Now, many times some of the boxes are empty, as the institution will only report amounts in boxes that pertain to that taxpayer. So here's an example of a Form 1099 INT for Tom Andrews, who received interest of $550 from a bank outside Massachusetts. He also received a $55 early withdrawal penalty. Note that the FATCA, F-A-T-C-A box is checked. If it is, this return would be out of scope. So FATCA stands for the Foreign Account Tax Compliance Act. I don't think I've ever seen one of those boxes checked, but if you ever do see one, it's out of scope. We also see 1099 INT forms as part of a brokerage statement. You enter the amounts as they appear in the form into the corresponding boxes in tax layer. Notice there are other tax forms contained within this one brokerage statement. There's a 1099 DIV for dividends with values and a 1099 OID does not contain any information. Here's the scope manual information on interest reported on a Form 1099 INT. Just reinforcing the idea that the scope manual should be checked whenever there is potentially an out-of-scope issue. All right, I'll start by saying I've only worked on a couple of tax returns that involved 1099 OIDs, or original interest discount. But you're going to see this in tax layer every time you go in to click on whether, select information for an interest tax form, a dividend, an OID, or seller financed interest income, like me buying a house from you and paying you interest. So here's how an original issue discount works. First, we'll talk about a bond, a normal bond. So you buy a bond, and once you purchase it, the bond's insurer pays you an interest rate, usually. It's called a coupon. So while you hold the bond, periodically you receive interest payments based on the rate of the bond. Now, when the bond reaches, let's say it's 5%. When the bond reaches maturity, which is a specific date when the bond must be paid back at its face value, you would receive the return on the face value paid for the bond, and you received interest while holding the bond. So an OID is different. An OID is like a bond, but it sells for a price that's less than its face value. So the OID, that discount, is the difference between the price paid for a bond and what its face value is. So the OID could be considered interest since the buyer has paid the face value at maturity, even though the purchase price was lower than the face value. So, for example, let's use an example. Say a bond has a $100 face value. You pay it's $100, meaning the investor would receive $100 returned at the maturity date. So if the investor buys this $100 face value bond for $95 and receives $100 at maturity, the OID, the discount, is $5. That's the return on the investment. So as opposed to a traditional bond, the gain from the OID is only realized at maturity when the investor receives the return of the face value principal. So OID is paid as a total sum at maturity, including the original amount invested. We'll look at the next option, dividend income, in just a bit, but I want to mention that the seller financed interest income I just mentioned it, it applies if you sold your home and provided the buyer financing instead of the buyer getting a home loan through a bank. So if the buyer pays their mortgage payments directly to you, then you have seller financed interest income. I want to talk about those because, again, on the screen you can see this is what it'll look like when you go in to enter interest income or dividend income. And I want you to know what the other options here are. This is what a Form 1099 OID looks like. This is treated the same as a 1099 INT. Again, enter the amounts exactly as they appear on the form in a tax layer. I would recommend with an OID, check the scope manual. You don't see that often. It may turn out that something could be out of scope. Reinvested dividends are taxable. I met with a taxpayer 2 years ago who tried to convince me that there was no tax on stock dividends that were issued to him because the taxpayer never received anything when the dividends were paid out. Now, the dividends were clearly listed on the taxpayer's brokerage statement, and they had been reinvested, which means they were used to buy more shares of the same stocks. So be prepared for taxpayers who make claims like this. Be prepared to show them the rules, or if not able, discuss this with your site lead. So very quickly, we normally see three different types of dividend statements. We could see a 1099 DIV statement shown as here from a mutual fund. And here, an individual stock dividend. And finally, as part of a brokerage statement. So just type what you see and enter the numbers as they appear on the Form 1099 DIV into the corresponding boxes within the tax layer entry screen. Now note, on this consolidated statement, it contains multiple tax forms, including a 1099 DIV, 1099 INT, a 1099 MASC, a 1099 OID, and a 1099B. Now, examine all the pages carefully in a brokerage statement. Try to make sure that you have all the pages. So if it's like 12 pages, on each page it's say 1 of 12, 2 of 12, etc. You may just need the consolidated page, but you want to have the details just in case you need them. So in lesson 4 thus far, we've covered interest and dividends now. And we're going to present demonstrations on both, on how to enter a 1099 INT and a 1099 DIV in a tax layer. So here is the 1099 INT example we'll use. And here's the 1099 DIV we'll use for our demonstration. I want to pause to ask if there are any questions for those of you who may be present in this presentation. Next is alimony income. It's important to note that the tax rules concerning alimony changed effective January 1st, 2019. So prior to changes made by the Tax Cuts and Jobs Act, alimony payments were tax deductible by the person making the payment. The person receiving the alimony had to claim it as income on their federal tax return. So after January 1st, 2019, alimony is no longer tax deductible for the payer and no longer reported as income for the receiver. Now, if divorce papers or decrees in effect prior to January 1st, 2019 are modified by a court to explicitly spell out that the repeal of the deduction for alimony payments applies, then payments under the divorce agreement will be taxed according to the new rules. Without any modification, the alimony payments for agreements entered into prior to January 1st, 2019 are still deductible by the payer and taxable income to the recipient. So basically, they're grandfathered. Now, to determine the rules that apply, the date of divorce or separation agreement, legal separation agreement, must be provided. And they should have been noted on the intake booklet. Now, before I leave this slide, I want to mention that alimony received is not taxable. So that means when it is not taxable, that the compensation can't be used for IRA purposes. Alimony received is taxable. It can still be used as compensation for IRA purposes, meaning earned income. So if someone received $4,000 in alimony in a year and it was taxable, then they could, if they had no other income, invest up to $4,000 in, say, an IRA. Slightly ahead of myself, the alimony rules, again, under pre-2019 orders is grandfathered. Alimony received continues to be taxable. It can be considered as compensation to qualify for an IRA, to be used for an IRA. Alimony payments continue to be deductible. So for alimony received, verify information that's in the intake booklet. Look at prior year's return. Was there any alimony income in a prior year? And confirm that it's required by a divorce decree or separation instrument, and ensure that the payment is not or does not include child support. Now, the taxpayer needs to provide information of the actual amount received in the current tax year. For example, $500 per month or the yearly total. And that should be noted on the intake booklet. Now, as we get into tax law and begin looking at credits and compensation for IRA contributions and so forth, you'll learn more about this. But at this point in time, just to say that alimony received is not earned income for the earned income credit. It's not earned income for the child tax credit. It's not earned income for the dependent care credit. And again, it is compensation for IRA contributions when it's grandfathered, meaning when it's from the pre-2019 rules apply. So taxpayers paying alimony are typically aware of the benefit. Verify the amount deducted is only alimony. Enter the total amount paid in TaxSlayer. TaxSlayer will require the date the divorce or legal separation took effect. So TaxSlayer, will automatically determine if the alimony is taxable deductible based on the date entered. You don't have to do that. We just need to enter the information. Now we're going to demonstrate how to enter alimony information in a TaxSlayer, but first we'll cover the subject of unemployment income, and we'll combine the entry of alimony information and unemployment income into one demonstration. All right, and here is a section on unemployment income. So unemployment compensation means a taxpayer is physically able to work but cannot, as opposed to workers' compensation, which means someone is physically unable to work. Unemployment is taxed. Workers' compensation is not taxed. Now, unemployment was exempt from federal taxation in 2020 for up to $10,200 due to COVID, but that's well past gone. So it's unearned income, unemployment compensation. It's not compensation for purposes of an IRA. It's federally taxable. It's received under federal or state laws. So it's reported under Form 1099-G with the income in box 1. State and federal taxes are often withheld. Now, by the way, in Massachusetts, if someone says they received unemployment compensation but they don't have the form, they can request a 1099-G, the form, from the Massachusetts tax office via an online account or a phone call. Here's a Form 1099-G with income shown as being reported in box 1, if there were some income here. Make sure to check for any federal tax withheld in box 4 and state tax withheld in box 11. The same form is used to report Massachusetts state tax refunds. So if this were for a state tax refund, the amount would be in box 2. So here's an example we'll use to demonstrate the entry of a Form 1099-G for unemployment income. For our alimony demonstration, we're going to enter alimony received by Elizabeth, which is income for her. We'll then demonstrate how the spouse would report having paid $350 per month in alimony. On this slide, you can see the tax layer navigation. For the receiver, it's income. So we're going to go to income alimony received. You'll see that in a minute, in the demo. And then the payer goes to deductions, adjustments, and alimony paid. And again, we'll show how to traverse, how to navigate, and enter the information correctly in tax layer in the demos. And that concludes our discussion on alimony and unemployment income.